Nilesh Shah joins in as well to talk about the market. This is the official pre-budget run for trade, which is sometimes quite good for us. Nilesh, morning. Good to have you on the show. Is it a durable pullback for the market, you think, after everything we've seen through January and February?
It's a bit difficult to say whether this pullback can be sustained or not. There are concerns on the local side, but the valuation is in your favor. I think the market will remain range bound and will move directionless till the budget, and the budget will probably create the ground for the next pullback up if it meets the requirements of the investors in terms of fiscal constraint.
Morning, Nilesh. Given how the setup is going into the budget this time around, do you think the budget will eventually turn out to be a market positive event?
It all depends upon how the budget is presented. On the last year, or on the current year, the fiscal deficit will come probably far below budget numbers. One, because of the unexpected bonanza on 3G, and second, because of the high inflation, which kind of pushes up nominal GDP. So instead of 5.5% deficit to GDP, we could be probably looking at 5%, which is pretty close to 4.8% committed for next year. Now, in the next year's budget, if revenue is kind of forecasted a little bit optimistically and subsidy is kind of taken a little bit out of budget, one can definitely present a budget which will be optically good for the investors, but that's not going to give them confidence or comfort. If we can present a budget which is balanced in terms of rationalizing subsidy and also devising ways and means by which revenue is charged appropriately through introduction of some of the provisions in DTC, then probably will give more confidence to the investors. And even though then our fiscal deficit numbers may not be looking as good, the confidence will come because that number will be more real rather than illusionary.
This year there was the expectation as well that there would be a lot announced in terms of infra spend, Nilesh, particularly from the public side. Because of this deficit issues that you just lined out, do you think the government will be able to be as brave as to go out and say we're going to spend XYZ amounts on infra?
I think what we need on infrastructure spending side is not only government support in terms of money, but we also need government support in terms of speedier approvals. If I can take just a minute about how India growth story is panning out, we had on a prime location in Worli, Mumbai, a pharmaceutical factory. It was producing life-saving drugs. Sometime back, the company sold that plot and now it's a barren land. So in terms of economy, we have lost out the life-saving drug in favor of a barren land. However, the way economics have turned out, the seller, the company is happy because they have received cash for their property. The fund which is invested in buying that property is happy because real estate prices have gone up. The developer is very happy because nothing has happened and nothing can happen probably without his approval or without his help. The investors are happy because they have paid 10% money for buying flats in that property and the flat prices have gone up. So economically we have substituted a life-saving drugs plant with a barren land, and still the seller, the buyer, the investor, the consumer, the developer, everyone is happy. We haven't created anything except an illusion. So what we need is a speedier approval whereby that barren piece of land can be converted into building. We really don't require just government's money. I think if we can balance this, then the infrastructure growth story continues forever.
Stay on, Nilesh.
Where do you stand on the entire earnings debate? How much slippage do you think we might see in FY12 on earnings performance?
Bit difficult to predict right now because there are so many variables which are changing. I mean, oil prices today are one concern, and earnings when oil is at 80 and earnings when oil will be at 110 will be totally different. On top of it, you have to probably add things like whether government will take the burden of subsidy or whether it will be passed on to the consumers. However, I think most analysts are today looking at earnings to grow at about 15 to 20% over FY11 base. And this is factoring in a normal monsoon, this is factoring in reasonable oil prices, this is factoring in a reasonable liquidity and interest rates. So as long as the quarterly earnings are trending around 15% level, I think that will be good enough for the market. One important thing is that the Indian markets today are trading at around their historical average valuation, which means they are not cheap, but they are not expensive either. They are at fair value, factoring in all the concerns which are around there. So if the quarterly earnings kind of trend little bit upwards of 15%, you will see quick rally in the market. If the quarterly earnings are trending little bit below 15%, then we may see a period of consolidation before market can pull back up.
But by and large, Nilesh, do you think the worst of this market got priced in at that 5200 level last week for the Nifty, or do you see meaningfully lower levels during the course of the year given how the macro is stacked up?
I think from a macro point of view, we are not that bad. Inflation is a statistical thing. At some point of time, it will come down because of base effect. It will come down because of statistical effect. Interest rates are probably inching up little bit, but they are nothing compared to what they were 10 years back. From a fiscal deficit point of view, growth can take care of deficit, and the government has so much of spending which is probably unproductive, that little bit of control over there and we could be through. So from a macro point of view, India is not looking as vulnerable where it can create a big gap into the market. From a fundamental point of view, I think we are unlikely to see market trending significantly below the low which we witnessed just few days back. However, one important point which I would like to bring out is the development of program trading in Indian equity market. So there are orders which are coming through computerized trading, and if the order comes without price limits saying that I want to participate in 50% of volume or 60% of volume or things like that, then even in a thin market the computer keeps on selling without looking at price, and this kind of creates an air bubble where prices can suddenly drop because someone is constantly selling. So we will see this kind of air bubble coming up because of the program trading. The second thing which is also coming up is that in some sense the futures and options volume at 90% of overall volume is also making traders little bit more important in overall context. So on a bad day when traders are in full form to short the market, they can create an air bubble again. So combination of program trading along with traders activity could bring down the market below its fundamental value. It will be probably momentarily, it will be temporarily, and if we ignore those kind of days, then I don't think so markets fundamentally are likely to trade below what the lows which we witnessed some time back.
Nilesh, you